Hello, this is Christopher Provo, CEO of Provo Wealth Management Group. No one wants to pay more than their fair share in taxes. But how do you gain access to the programs available when you are working on day-to-day demands of running your business? Between getting your product out the door, dealing with industry and government regulations, or hiring in this low unemployment environment, how do you find and verify that a team of experts are available? That's why the Worcester Regional Chamber of Commerce has provided this workshop with us to support you and bring you this vital information. You may not be able to control the price of steel or the fact that your younger people are not eager to go into the manufacturing industry, but you can make an impact on your bottom line by using these programs. Obviously, you know we are very close to the end of the year and have a short period of time to determine if these programs will work for you, never mind executing them in 2018. We will have a checklist to give you at the end of this that will define whether you are eligible for one or more of the programs. We want you to know your rights under the law and how to access and implement programs that are yours for the taking. Your biggest costs are labor, materials, and taxes. This is going to be an eye-opener. You will likely hear something that you are not familiar with. Does not mean that it's not true. It is likely that most every good idea that you implemented in your business was at first new, unfamiliar, or an unproven entity in your company. We are not talking about hypothetical theories here. We are showing you how you can have an impact on your bottom line this year. We will show you today 4 ways to decrease your tax bill by 30%. Our speakers today are David McLaren, President and CEO of McLaren Associates CPAs, Christopher Provo, Provo Wealth Management Group, Christopher Hines, Attorney at Law, CFP, Tax Law Solution, and Steve Powers from R&D Intrepid Advisors. They're the research and development tax credit experts.
Hi, my name is David McLaren. I'm the founding and managing partner of McLaren Associates CPAs in Shrewsbury, Massachusetts. I wanted to talk to you today about some new and expiring tax laws and some free deductions that you can get. Now, my firm, McLaren Associates CPAs, we specialize in proactive tax strategies for businesses, showing them the deductions, credits, and elections that they're missing and not taking advantage of, forensic accounting and fraud detection, as well as fraud prevention, showing people how to avoid problems from happening, and if anything does happen, we handle cases where employee theft has gone on, partner theft, divorce cases where assets are hidden, estate cases where money is lost, stolen, or hidden. And we also perform business valuations, whether those are for divorce cases, estate tax cases, you want to buy a business and know what it's really worth, or sell your business and get top dollar for it. I have 5 certifications. Those include CPA, which is Certified Public Accountant, most people are familiar with. I'm also a Chartered Global Management Accountant, which is a designation for people who have run both local, national, and international businesses, showing them how to become more profitable, pricing properly, avoiding risks, and making companies stronger. I'm a certified forensic accountant. That is someone who has gone through a significant amount of education and exams in order to get their designation for tracking down lost, hidden, or stolen money. I'm a certified governmental forensic accountant. That is a certified forensic accountant that also has worked with the government, and my experience has included working with the Ministry of Defense in England, as well as the Department of Defense in the U.S. and the FBI. And I'm a registered forensic investigator as well. I've been performing services for clients for over 33 years, and then want to get into what one of the old laws are that many people have missed. Unfortunately, 90% of people who are eligible for this particular deduction never took it. And that's an expiring tax law called Section 199, also known as the Domestic Production Activity Deduction, or DPAD. This is where a business that constructs or manufactures anything in the United States is eligible to get 9% of their profit tax-free. So you don't have to write a check out for this deduction. You fill out paperwork, and if you're eligible, you get 9% of your profit tax-free, or 50% of the wages of the business, whichever number is lower. Now, the good news is, for people who didn't take advantage, we can go backwards, amend your tax returns, and get that money back. The qualifications, though, as I mentioned, you do have to manufacture or construct something in the United States and have wages in the United States. That tax law expired at December 31st, 2017. We can go back and amend your tax returns for the past 3 years, which means if you didn't take advantage of this, as many people did not, we can go back to 2015, 16, and 2017 and redo your tax return to file for this deduction to save you taxes on it. But the window to go backwards is closing quickly as well. So if that's something that's been missed, we want to go back and make sure we can pick that up before you lose that opportunity. It's for manufacturing profit and revenue or construction profit and revenue. It's not for other types of revenue like consulting or for other services that you might perform. Now that tax law expired December 31st, 2017 and has morphed into a new tax law called Section 199A, which takes effect in 2018. Now this particular law is for flow-through businesses only, and businesses structured as a flow-through business. A flow-through entity is a business structure where the business does not pay income taxes, but the business owner on his personal or her personal tax return will pay tax on the profit of their business. So these entities are S corporations, partnerships, sole proprietors, LLPs, and LLCs, but only if the LLC is being treated like a flow-through entity, like a sole proprietorship or partnership. C corporations, regular corporations, are not eligible for this particular deduction. And the business owner cannot be an absentee owner or just an investor. They must actively run and be involved with the business to be eligible for this. Now, how does this new law work? So, eligible business owners get to take 20% of the profit of their company as a deduction, or 20% of the business owner's taxable income as a deduction, whichever is smaller. But this could be a huge tax savings if done properly. Now, as I mentioned, if the business owner is not active in the business, you're not eligible. If you're a C corporation, you're not eligible. But of course, in the tax law, just like any other tax law, there's always limitations and complications. One of the additional limitations is, so as I first stated, you get the lesser of 20% of the profit of the company tax-free, or 20% of your taxable income on your personal return, whichever is less. If you are a single business owner, you file single on your personal return, and your taxable income is above $157,500, or if you're a married business owner and file married on your tax return, and your taxable income is $315,000 or more, a third limitation kicks in. And that limitation is 50% of the wage expenses on the company's books. And it has to be W-2 wages. 1099s and subcontractors do not count. So that means if your income is over those amounts that I mentioned, the rule works like this. You get the lesser of 20% of the profit of the business tax-free, so you get that as a deduction, or 20% of the owner's taxable income, or 50% of the wage expense on the business's books, whichever is less. Now, you may hear that there is another phase out that certain industries like professional services, legal services, accounting services, healthcare services, consulting services have a phase out where if they make too much money, they don't get this deduction at all. But the rest of the business entities out there, manufacturers especially, get to take the full deduction. And again, it's the lesser of 20% of the business owner's taxable income, 20% of the business profit, or 50% of the wages if your income is above those thresholds. So in wrapping up, keep in mind C corporations are not eligible, so potentially looking at converting to a different type of entity may be beneficial, but that's specific to your case and would need to be examined. Any adjustments in tax strategies you use to be eligible in 2018 must be done before December 31st of 2018, so that window is fast closing. So please contact us so we can help you set up the best tax strategies, use this in the best way, and have it set up specifically for you and your business. Contact us to see if you're even eligible, and we can certainly go over other tax strategies that you might be eligible for that could significantly save you money. Again, David McLaren, McLaren & Associates. I truly appreciate your attention to this, and if we can help out in any way, feel free to contact me. Thank you.
Hello, I'm Steve Powers. I'm the president of Intrepid Advisors, and today we're going to talk about the R&D tax credit, strategic tax advantage for manufacturing and technology companies. And before getting started, just want to tell you a little bit about my company, Intrepid Advisors. We're actually comprised of tax accountants and engineers who've a significant number of years in industry. And our firm is very knowledgeable of the IRS regulations relating to the R&D tax credit. In fact, it's all that we deal with. We have clients nationwide, and we've been helping these manufacturing technology companies for more than 30 years now. So as for the R&D tax credit, it can certainly provide significant reduction of corporate taxes for any number of businesses. The research credit came into being nearly 40 years ago, and it was inaugurated by Congress to help promote economic growth in the United States, as well as stem the migration of manufacturing away from the United States. And today it remains a very strong incentive for companies involved in developing new technologies, or in fact companies who are exercising innovation in the product development and software development activities in which they're involved. And as for the history of the R&D tax credit, it was established by Congress in 1981, nearly 40 years ago. At the time, it was a temporary piece of the tax code, and later the initial tax credit legislation was amended in 1984, and then again in 2007. And because it was a temporary piece of the tax code, it had to be extended as many as 18 times. And finally, in 2015, Congress made the R&D tax credit permanent. It was a provision included with the Protecting Americans Against Tax Hikes Act, and there was provision in that bill that made the research credit a permanent part of the tax code. Also, in 2017, there were some provisions in the Tax Cuts and Jobs Act that has some impact on the R&D tax credit as well. And for those unfamiliar with tax credits, the R&D credit is not a deduction, but rather a tax credit or credit against tax liability. And the R&D credit can be utilized by not only C corporations, but S corporations, LLCs, and partnerships as well. So in addition to the federal research tax credit, 39 states also have tax incentives for their manufacturing technology companies. In this graphic, the states highlighted in green represent the states that have research credits, which include Massachusetts and all the other states in New England. And of course, the states that are highlighted in red presently don't have an R&D tax credit. And as for companies that can actually claim the credit and use the credit to offset taxes, it's quite a long list. It includes medical device manufacturers, metal treating companies, food manufacturing companies, plastic injection molding, precast concrete companies, engineering firms, automotive or companies involved in automotive components, and many, many more types of companies, including software development firms, which are growing in numbers each day. And as for companies that can claim the R&D tax credit, that would include companies who are involved in developing new or improved products, companies who are involved in developing new or improved fabrication processes, or companies involved in developing new or improved software. And I might just point out that companies' development efforts do not have to be successful. So in many cases, unsuccessful development attempts at either a product or a fabrication process or a software is a qualified activity. And the research tax credit itself is somewhat of a complicated calculation. The computation takes into account the taxable employee wages, or some portion of the wages of the employees who are involved in the company's development efforts. It also includes the cost of materials that were consumed in the company's development efforts, as well as the costs of any contracted labor or outside services. And finally, companies who are involved in developing software often are leasing server space, and this leased server space, the cost of which can also be included in the company's research and development tax credit calculation. And as I mentioned a few moments ago, the provision in the PATH Act of 2015 made the R&D tax credit a permanent part of the Internal Revenue Service Code. The PATH Act also included two other interesting provisions. One of the provisions would allow certain qualified small businesses to offset their FICA tax using their research tax credits. And the other provision would allow flow-through entities, the shareholders of flow-through entities, to use their research credits to offset their alternative minimum tax. And we'll talk briefly about both of these provisions in upcoming slides. As for using the R&D tax credits to offset FICA, qualified small businesses are those corporations or partnerships having gross receipts of no more than $5 million during the current tax year, and as well as those companies that did not have gross receipts for any year preceding the 5-year period ending with the current taxable year. In other words, companies that have been in business for 5 years or less and who have revenue of under $5 million would qualify to have their FICA tax offset using R&D tax credits. So these types of businesses would essentially be pre-revenue type companies, companies who have venture capital investment, or companies who just haven't quite turned a profit yet or not paying taxes. So quite a lot of companies, new companies, could fall into this. Particularly software development companies are a prime candidate for using their credits to offset FICA tax. And prior to the PATH Act of 2015, corporations and flow-through entities such as S corporations, LLCs, and partnerships were limited in how they could use their R&D credits. Previously, these companies could only reduce their regular tax down to the alternative minimum tax level, which meant that often, particularly S corporations, LLCs, the shareholders of such businesses could not use the entirety of their research credits and would therefore have to carry their credits forward to a subsequent year. A provision in the PATH Act now permits all these corporations to reduce their alternative minimum tax down to zero, if possible, using the research credits. So as a result of the PATH Act 2015, the limitation associated with alt minimum tax has been eliminated. Now this provision applies to C Corps, S Corps, LLCs, partnerships who are not publicly traded. And then there was tax reform of 2017. In 2017, as Congress considered a reformed or new tax package, Congress remained a staunch supporter of the research tax credit. The House Ways and Means Committee reportedly said, "The R&D tax credit will remain a valuable incentive that will continue to strengthen America's technology base while promoting economic growth." In late 2017, Congress did pass and enact the Tax Cuts and Jobs Act. It was quite an extensive tax package. One of the provisions in the bill reduced the corporate tax rate from about 35% down to a maximum of 21%. This particular provision would allow C corporations in particular to derive a greater cash benefit from the research tax credit. Also in the bill, Congress eliminated corporate AMT. And as we mentioned a couple of slides ago, corporations having revenue greater than $50 million would still be subject to alternative minimum tax limitations regarding their R&D credits. The elimination of alt minimum tax, therefore, eliminates the problem altogether. So C corporations now, beginning with tax year 2018, are not limited whatsoever by alt minimum tax regarding their research tax credits. Further, the TCJA, or Tax Cuts and Jobs Act, had a provision which allows flow-through entities such as S corporations, LLCs, partnerships to reduce their reduce their taxable income. The law now permits these companies to take a 20% pass-through deduction on their qualified business income. This doesn't have too much of an impact on the research credit. However, the Internal Revenue Service recently released a new tax form pertaining to the research credit, which allows these flow-through entities, in particular S corps, LLCs, to derive a much greater cash benefit from the research credits. The increase benefit is about 50% greater cash benefit than they formerly would have derived from the credits. And so, should you have any questions about the R&D tax credit, or should you like to discuss the credit in more detail, please feel free to contact me at spowers@intrepid-advisors.com. And thank you for listening.
Hello, everyone. I'm Chris Hines, Managing Director of U.S. Tax Consulting for Tax Law Solutions, and today we're going to talk a little bit about your tax planning for this year and how we can save you, if you're a business owner paying $75,000 or more in taxes, how we can save you a significant amount of money on your taxes. So who is Tax Law Solutions? The beginning started with Richard Kolumbic, who's a tax attorney and CPA. He met up with Dave Runge. They were both working at Deloitte. They were both managing directors at Deloitte. And Richard helped Dave solve a very large tax problem. And what Tax Law Solutions from the beginning has brought to the business owner are big company tax strategies and brought them to the small to mid-sized business owners. And so that's what we do. Some of you may have seen this quote: in America, there are two tax systems, one for the informed and one for the uninformed, and both are legal. And that's from Judge Learned Hand. So we're going to talk to you today a little about what we do in terms of informing you of tax strategies that you may not know about. And really how we're different is we're proactive, whereas many tax advisors focus reactively on accounting for last year's taxes. What we do is we try to figure out if there are new ideas and new strategies that you can implement in your business to significantly reduce your taxes. And so the bottom line is that many of you just don't know where to get sophisticated tax advice, and you feel like you're doing everything you can. Been comfortable in that false belief, you haven't sought or don't know where to get more sophisticated tax planning advice, or you've been led to believe that any method, any sort of additional strategy, tax reduction strategy, that may enable you to pay less in tax is risky or illegal or too aggressive or just simply too good to be true. So let's test that assumption. So find your anticipated income for this year or the approximate income for this year, and say in 2018 or even for 2019 in the following table. So 231,339, 520, 1.5 million. What do you believe, or what have you been told is your tax rate, or will be your tax rate on that income. Got a number in your head? Well, compare your anticipated tax rate, the number you envisioned, to the tax rates in the following table. And these are from the IRS. So the IRS has said that if you're making, for example, $520,000, your effective tax rate should be about 17.6. Think about that for a second. I'll bet the number in your head was probably a little higher. So if your anticipated tax rate was higher than the tax rates on the table, you're paying far more in taxes than is legally necessary according to the IRS average. And by the way, that's an average. So that means that half of taxpayers in that income category are paying less than that percentage. So what are you going to do about that? How does that make you feel? Probably not great. So what Tax Law Solutions is we're a highly skilled group of tax attorneys and support staff that design and implement comprehensive and customized strategies that enable our clients to dramatically and permanently reduce their taxes. And we've structured over 6,000 tax plans customized to our clients' business and personal situations. And in every case, those clients already had tax advisors and believe they were already doing everything they could to reduce their own taxes. But we reduced those taxes for those clients, those business owner clients, by an additional 30 to 40% relative to prior year's taxes. In many cases, it was far greater than that. So the question then becomes, how much longer can you afford to wait before taking control of your largest single expense? And oftentimes we hear that business owners cannot change the revenue. You know, we're trying to develop more business. The top line is where it needs to be, but it's the bottom line that's the problem. And so if your single largest or one of your largest expenses is taxes, and you can lower that expense by 30%, even 40% or more, why wouldn't you at least explore whether that's something that we could do for you? Learn what you've been missing that could change your lifestyle, or help you pour money back into the business to develop more business, to grow that top line and preserve more money for yourselves and your family and your business. So once we determine how much of your taxes can be reduced, we sign a contract guaranteeing exactly how much we're going to save you. And then we develop a comprehensive capital preservation report, which is our deliverable. It's fairly thick. We have probably 45 different strategies that we can use. We never use all 45 with any one client. We'll probably use 5 to 10 or 12 strategies at the most to reduce your taxes. And we customize each of those strategies to your business and personal tax situations. And all the strategies that we recommend have already been tested, already being used by thousands of other taxpayers. They're just not being used by you yet. And again, you're part of the uninformed. You don't know what you don't know, as they say. So here's how we work. You provide us with your last 2 years' business and personal returns. We answer, we get on the phone with you. It's about a 15-minute process tops, but we help you answer a questionnaire that helps us identify other applicable areas of tax reduction. We then analyze your situation and project the potential tax savings, and we provide a contract specifying the savings and tax reduction strategies. And then we customize your plan. We deliver the capital preservation report. And then over the next 12 months, we implement the tax reduction strategies with you and with your internal team at your business and potentially your external team, your CPA and or other tax preparer. So we work collaboratively as part of a team. We're not looking to disturb relationships. We're looking to enhance those relationships and make sure that everyone is doing what they do best and working for your benefit. So either way, you really can't lose. Either learn how to save taxes, or if we can't find ways to reduce your taxes, you'll get peace of mind knowing that you're not overpaying your taxes and that your current tax advisors are doing the best job for you. And then you will save taxes every year going forward. These strategies we recommend, even though our initial engagement is a 12-month engagement, you'll save taxes every year going forward. These are evergreen strategies, as we like to say. And the amount of tax you save could change your lifestyle. End up on the beach somewhere. So anyway, that's a quick presentation and overview of who Tax Law Solutions is. I thank you very much for your time and your attention. Again, I'm Chris Hines, Managing Director of U.S. Tax Consulting for Tax Law Solutions, and I look forward to speaking with you soon. Thank you.
Hello, this is Christopher Provo, President and CEO of Provo Wealth Management Group in Shrewsbury, Massachusetts. I'm here today to talk about dynamic tax reduction strategies for 2018 and beyond. Our concept today is tax harvesting. This is the process of taking capital losses in your investment portfolio in order to offset short-term and long-term capital gains. Often a client has sold a position for a substantial gain. Could be short-term, but usually in the case of a long bull market like we've been in, it's most likely long-term capital gains. In some instances, a fund may have distributed some capital gains at the end of the year. By selling stocks or other investments that have incurred a loss, you can reduce your taxable gains, both short-term and long. For example, a client wants to sell profitable stocks to take profits and diversify their allocations elsewhere. It would not be uncommon for a client to feel the stock has had a great run and now it's time to buy something else. Diversification, asset allocation are some of the reasons why people want to spread assets out, and selling something that has doubled or tripled over the past 10 years might be a great way to do that. Let's say that a gain on a few liquidation totals around $200,000. With a 20% federal capital gain tax, this investor would be writing a check to the IRS for $40,000. And that's not including any state and applicable local taxes if they apply. If we could find a security or multiple securities and sell off losses of $100,000 or roughly the gain, we would cut the tax payment in half by saving the investor $20,000. No one likes paying more than their fair share of taxes, so the idea behind it is how can you look at your portfolio from a net return perspective? Can we reduce the amount that we would pay the IRS, thus saving you real dollars? Let's assume that you still like the position despite the positive gain. What can we do there? So you want to take the profits, you're worried about potentially losing money, you want to diversify the portfolio, but yet you still like the underlying security. Often what we can do is to buy options, buy calls on that underlying security, so that you're selling the stock or ETF, but then buying an option on the underlying security. Another strategy is to simply wait the 30 days, buy back the position. If you buy it back sooner than 30 days, you won't be able to harvest that tax loss. So it's important that you follow the IRS guidelines when it comes to this strategy. If you'd like to talk to me or anyone else from our firm about this matter, please give us a call. The number is 508-842-0539, or reach us at chris@provowealth.com. Thanks for your time and consideration. Have a great day.
Well, that was quite a presentation by these amazing experts. I'm Pam Provo. I'm the Executive Vice President of Business Development and Marketing, and I would like to turn your attention to the advisor's contact information should you want to find out if you qualify for one of these programs.